In a recent interview with Financial Times, the former governor of the Bank of England, Mark Carney, was asked about Brexit, and his reply was, back in 2016, UK GDP was around 97% that of Germany. But in the past 6 years, the UK economy has slipped behind, and now the UK economy is only 70% of the size of the German economy. A polite way of saying that Brexit is severely limiting the UK's potential. Why is this? What damage is Brexit causing, and could it get worse in the future? Well, first of all, the UK chose the hardest Brexit, leaving the single market and the customs union. And this has led to a big increase in the friction of trade between the UK and the European Union. Firms now have more paperwork for importing and exporting, and there can be higher customs duties for the import of some goods from the EU which originate outside the EU. So all of these new frictions and uncertainties led to a significant fall in trade, especially in 2021 when the UK left the transition period. So you can see here that trade fell by 14%. Now, to some extent, this can be blamed on the COVID pandemic, rising import prices, and it's not just Brexit. But if we look at the OBR's research, you can see here that the UK was adversely affected compared to other countries around the world. So although all countries have been affected by COVID, the UK hit has been much harder, which shows why UK GDP is falling behind many of our competitors. The OBR predict that UK GDP is 4% less than it otherwise would have been. Similar report by the Centre for European Research found a slightly higher figure, that UK GDP is around 5% less than it would have been if it stayed in the single market. There are many problems of Brexit, and there's no big bang crash like the mini budget caused a rise in interest rates. It's more like an accumulation of small frictions which make trade and economic growth more difficult. A good analogy is that Brexit is a bit like a slowly deflating balloon. We don't necessarily notice it at the time, but the accumulation is that GDP is less than what otherwise would have been. And although there's been no spectacular crash due to Brexit, there is a growing realisation that Brexit is hurting the economy. And even this week in the Daily Telegraph, which supported Brexit, the economist Jeremy Warner pointed out how much damage Brexit had caused in the past 6 years. So although Brexit has been an emotional subject, a subject that often people want to avoid talking about for fear of getting into a debate and argument, maybe that is changing. So UK trade has fallen by about 14% in 2021. There has been some recovery in the summer of 2022, with exports to Europe recovering, but there's still a long way to go to catch up with what we have lost. Also, there are many other problems around Brexit. So, for example, the new passport checks that have occurred due to Brexit have led to record tailbacks at Dover, causing problems for lorries and passengers going on holiday. And this increases the costs of trade, makes the UK less attractive as a tourist destination. I noticed Brexit when trying to book a Eurostar ticket. The price was much higher than a few years ago. And the reason is that Eurostar cut services by 33%. Because the new passport checks take an extra 15 seconds per customer, and therefore they've had to cut services. And with less services, the market price tends to rise. Also, the end of free movement of labour has perhaps exacerbated the labour shortages the UK has had for quite a while. Although there are many pressures on the labour market apart from loss of free movement of labour from Europe, particular industries, especially hospitality and farming, have really struggled to fill in labour vacancies without the free movement of labour from the European Union. Now, it was hoped that this end of free movement of labour would lead to rapidly rising real wages. And apart from a few months in the end of 2021, real wage growth has been very disappointing. There's been no boom in real wages. Again, many factors are at play, perhaps most importantly the rising energy prices, rising inflation. But the hoped for benefits of rising wages of Brexit have not occurred. Another problem of Brexit is that it's making the UK less attractive to overseas investors. If a company has a choice between investing in the single market or investing in the UK, there's always going to be an advantage to investing in the single market and avoiding the paperwork, regulations and possible tariffs of investing in the UK. And in the UK, we haven't always been aware of how the UK's reputation has been damaged abroad, because it's not something the media always wanted to promote. But if you look at American media, European media, the reputation of investing in the UK has gone down for the uncertainty and the confusion around Brexit, and also the very practical costs. And this is a big problem for the UK, because investment has been very weak and it's fallen in recent years. And this is an important factor in contributing towards lower growth. Now again, of course, there's many factors affecting low investment, not least weak demand, high prices and the prospect of rising interest rates. But Brexit definitely hasn't helped. Another problem of Brexit is that it really puts a lot of pressure on the government, because with lower GDP, tax revenues are rising at a slower rate than they used to. And this has caused the tax ratio as a percentage of GDP to rise to a record level, at least for a few decades. And this is an unwelcome political reality, because governments want to be cutting taxes and increasing spending. But with lower economic growth, the pressure is to have to increase taxes. Now, recently the UK government under Liz Truss and Chancellor Kwasi Kwarteng realised how UK growth has slipped behind, and they introduced a budget to go for growth. And their philosophy was to cut taxes primarily for high earners and corporation taxes. As we've discussed in a previous video, this was a complete disaster, and they've had to U-turn on quite a lot of it. But it shows how Brexit has narrowed the UK's options. They hoped that the solution to the UK's low growth is to cut taxes and deregulate markets. But there's very little room to cut taxes in the UK, because economic growth has fallen behind. And the irony of their growth strategy is that if you really want a quick fix to increase economic growth in the UK, there's three very simple measures. Number one, rejoin the single market and customs union, encouraging trade. Secondly, end restrictions on immigration. Free movement of labour would help to boost labour supply, demand for labour, and fill in labour vacancies. And number three, reduce planning regulations. Now, there are other reasons not to do those policies, but if your aim is only economic growth, then these policies would help. But back to the costs of Brexit. The problem is that at the moment, with very little prospect of any change in tariffs, there's going to be a long-term downward pressure on UK trade. There's a pressure for UK companies to relocate abroad. At one point, around 43% of financial services companies said they would move some jobs to Europe, and the recent turmoil on the UK financial markets may only increase this. A big financial firm, Revolut, recently announced it would move its workplace from London to Lithuania. So there's going to be a steady drip of firms relocating from the UK to Europe or not coming here in the first place. And this will limit the amount of inward investment the UK attracts. And another problem the UK economy has is a growing trade deficit. So the decline in exports to Europe is a real problem when you consider how much the current account deficit has increased. And this is only going to get worse this winter with rising energy imports. And the problem is that if the UK is less attractive as a source of capital investment, then it's harder to finance the current account, and this will put more downward pressure on sterling. Now, sterling has been in long-term decline for many decades. Since the Second World War, sterling has been devaluing. But Brexit has undoubtedly exacerbated the decline. Starting with a vote in 2016, it led to a sharp depreciation in sterling as investors reduced their expectations of UK economic growth. And after leaving the EU at the end of the transition period in 2021, sterling has continued its downward slide as export revenues are weaker than expected and there's less demand for investing in the UK. And this depreciation in sterling is becoming a problem because it leads to higher import prices, higher energy prices, and although the devaluation in the pound is not as strong against the euro, it still has been declining. So outside the European Union, the pound looks increasingly weak. And if you look at the underlying value of sterling, there could still be further ways to fall because UK inflation has been slightly higher than many of our competitors. Now, it's true that many countries have been affected by rising energy prices. We've got high inflation in Europe, just like the UK. But since the Brexit vote, UK inflation has been slightly higher, which causes downward pressure on sterling. Now, it was hoped that Brexit would lead to certain benefits, such as new free trade agreements with countries around the world. But unfortunately, this has not materialised. The US are very reluctant to sign a new trade treaty with the UK, especially with problems ongoing with Northern Ireland, which is important to the United States. The UK has been trying to negotiate a free trade agreement with India. But again, often when countries want a free trade agreement, they want better conditions on immigration. But it is unfortunate the amount of costs that Brexit has imposed on the economy, especially at a time when we've had low growth, low productivity, and increased pressure on government spending. So the outlook's not so good, but economies are always flexible, and there may be better news on the horizon. But just at the moment, with a disastrous mini budget, if anything, the costs of Brexit are going to be magnified, because the UK economy is really struggling, not just with the problems of Brexit, but also rising interest rates, unsustainable government debt, and high inflation. So it gives the government very little room for manoeuvre, and the hoped for tax cut miracle was kicked out by the markets very quickly. So it really leaves the government at square one. They have this problem of low growth, but no real solution to deal with it. Hope you've enjoyed this video. If you like it, feel free to subscribe and give a video a thumbs up. There'll be lots more videos coming out soon, because there's lots of interesting things to talk about in the UK and global economy. Thank you.